Thank you very much for having me on. I think it's been about 2 months since I was last on, and there's been a lot that's changed since then. We've had a number of announcements out on 2 of our 3 assets. We've raised a bit of capital for one of those assets, and what I want to do is take you through the update today, and also explain how we will allocate the money that we've raised and the money that we're generating to realizing growth. Now, just to remind you, before we get into the presentation, a little bit about Shanta's history. Now, Shanta's been producing gold for 8 years. I think I've looked at the numbers, and we've generated just shy of $1 billion of gold sales. That's a lot of track record to speak of. And that track record is really important because when we operate in places like Tanzania and Kenya, you need experience, and so that's key. Now, within those 8 years, the bigger picture is we've been operating in Tanzania now for 20 years, and at the moment, we are generating about $100 million of EBITDA every year at this gold price. So very, very interesting, and particularly interesting when you look at it versus our market cap of about $200 million today, with a pristine balance sheet. So that's pretty exciting, and there's a lot in our portfolio that we want to demonstrate. Now, the way we think of Shanta today, which is a lot different than what it was 3 years ago, is it's a value story plus a growth component, and that's a big differentiator from where we were 3 years ago, which was just purely value. We had one asset, it was well invested, and we were generating cash. But today, there's a very market and compelling growth component to that. Now, on slide 3, I've been the CEO now for just over 3 years at Shanta. I've been traveling back and forth to Africa for about 7. I'm Canadian, came through the investment banking world with UBS, spent a number of years in Asia, and overall supported by a really strong board out of UBS, Deloitte, Rio Tinto, and our founder, Ketan Patel. Now, a little bit more about this value and growth story that I talked about. Here we are on slide 5. The new Louisiana gold mine is our flagship producing asset. It generates $100 million of EBITDA at this gold price, which translates into about $50 million of free cash every year. It's on track to produce 80,000 to 85,000 ounces of gold this year at an all-in sustaining cost of $830 to $880 per ounce, and we're comfortably on track for both of those targets. And those targets were set before the pandemic, so we haven't tinkered with any of these estimates. These were set about 12 months ago. So we're proud of that asset. And now what we'll do is we'll take you through that asset in a couple of slides. The value proposition, what really matters at New Louisiana, it is mine life extension. So just keep that in the back of your mind. How many more years can we add to the mine? Now, onto the growth side of the story. Remember, it's value plus growth. And on the growth side, we have 2 assets, and a lot of news has come out of these 2 assets in the last 2 months. In fact, West Kenya project, which is Africa's highest grading plus 1 million ounce deposit on the continent, and the Singida project, which we've owned for a long time and is now in construction. So we'll take you through a bit of that in a few slides. Collectively, we own 3 assets in 2 countries, 3.2 million ounces contained, and at a high grade of about 3.6 grams for those 3.2 million ounces. So good quality portfolio of high grade, attractive assets in the ground. Now, what have we been up to over the last couple of years? This is important because this really sets a story for the value side of the equation. It's been a deleveraging story. When I came in mid 2017, the market cap was about $30 million, and I think at the gold price then we had way too much debt to deal with, and so we took that opportunity to delever. I'm not going to go through this because a lot of you already know all about it. And we saw a re-rating. So as the debt goes down, the equity value expands, share price goes up. It was pretty straightforward. Now, on to the next leg of the story, which is growth. But before we get to that, sorry, one more slide here on the value. You can see the debt going down, the cash flows are strong, and part of this value story is a dividend policy. We will pay a dividend in April. We haven't set the policy yet, but we've committed to paying something, and that's on record. So again, you can't be a value story if you're not paying a dividend, in my mind, and we will do that. Now on to the growth. West Kenya, we acquired it from, this is an asset we acquired from Barrick. We closed the transaction in August. We published a scoping study in October, and we effectively are sitting on a fantastic deposit with a lot of value. We show about $425 million of NPV at 1,900 gold price, and not enough money to develop it. So we were completely undercapitalized to move this project forward. We want to do it faster. We want to do it more quickly than we could otherwise do with our own cash flows. And we raised capital last month, which was very well received from new investors. They saw the story. Now, let me just give you two key numbers on what the West Kenya project has in terms of potential. We bought the project for $12 an ounce. We paid $14.5 million. We acquired 1.2 million ounces. We think that a project like this, which is very high grade, 12.5 grams per ton, with the reserve should be valued at about $300 per ounce. That's not me making it up. It's what the market values those types of projects at. And so our goal over the next 36 months or less, with the funds that we've received from that capital raising, is to deploy it into infill drilling, a bankable study, and expand the resource, to move it through the development curve, and ultimately get to a reserve that we think will be multiples higher in valuation than where this project is today. That is the basis of why we think taking permanent capital last month was far outweighed by the upside of the West Kenya project. And here on this slide, if you look at slide 9, you can see it. You go right to the right-hand side of the page of this bar chart. $340 million of NPV. That's at $1,700 per ounce gold price. West Kenya is by far the single biggest piece of growth potential in our portfolio. This has the potential to really change Shanta. So it's for us, it's really exciting. Now, this slide, we've tried to make it as simple as possible. I'll summarize it. In a nutshell, our market cap today is about $200 million. We think that's a safe assumption, is that's fully underpinned by our producing asset, the new Luigi Gold Mine. Then if you go on to the growth portion, which we don't think is represented at all or very little in our share price, that's what we would need to demonstrate over the next 3 to 36 months. And I'll take you through the catalyst of what we're going to do with those two assets to show that they're worth a lot more than what the market's giving us credit for today. What are the drivers? What's important when you look at Shanta? 3 assets, and we'll go through them one by one. The first one is the new Luigi Gold Mine. Now, I mentioned this already. The single most important point here is mine life extension. Why? Well, we've already invested as a company $250 million into this project. It runs very well. It has a very experienced team. The costs are under control. We manage capital very carefully. It's disciplined. And our strategy with New Luigi is to add more years of mine life. Now, just recently, we talked about expanding the plant size. So we talked about expanding it by about, I think, 12 or 13%. That's increasing tonnage, which allows us the flexibility to lower grade without compromising our headline production number. That's important because there is a lot of low-grade material around the new Luigi Gold Mine, and that comes in very handy when we want to blend it with high grade from the underground. Now, I'll put this in context. This slide basically shows that when we drill at New Luigi, historically, we've been able to replace the ounces that we mine, other than in 2017 and 18 when we didn't drill. because we were too busy repaying debt. Last year we drilled, we added 106,000 ounces of reserves. This year we drilled, we've added 2 new ounces of reserves for every ounce that we've mined, which is a good track record, and we'll be adding more money to exploration next year in the budget. For every year of mine life we add at New Louisiana, it adds $50 million of free cash at today's gold price. The Singita project really has 2 catalysts to keep in mind, 2 major ones. The first one is moving it through the construction stages. And I'm pleased to say that that process has started. Singita is fully funded from the cash flows that we generate at New Louisiana. We've planned it to be over about a 24-month construction period, and that can be very well managed and funded internally. So that's one. But the bigger story with Singita, because we always get the question, well, it looks quite small. You know, on a reserve basis, you're right, it is. But reserves are only delineated by additional drilling. Now, we've already allocated money to infill drilling at Singita next year. We'll actually be starting at the tail end of this year. So those are your nearest catalysts for Singita. And the headline number to look at here is that 91% of the ounces in the mine plan at Singita are only within 120 meters of surface. Now, if we apply that same logic to our New Louisiana mine, for instance, you know, going back many, many years, you would be completely ignoring the last 4 or 5 years of production that we've had out of that project. And our geologists are very confident that through additional infill drilling and exploration at Singita, on pretty modest amounts of spend, we'll be able to add new ounces to the mine plan. Now on to West Kenya, because again, if we go back to that value bar chart, West Kenya is the single biggest component of our 3 assets. It's the biggest value contributor. We acquired it for $12 an ounce. We're aiming on this slide we showed here to get to 786,000 ounces of reserves at 12.8 grams per ton. That's in 3 years or less. If we can do that, Shanta will not be the same market cap as it is today. 786,000 ounces of reserves at 12.8 grams per ton is worth a lot of value. And again, as I said, you know, the market would value that at about $300 an ounce. That's why we took the decision to raise capital and move West Kenya ahead as fast as possible, because we're effectively sitting on a very valuable resource. Now, the phases of drilling are threefold. I think the rig is literally being deployed now from northern Tanzania into West Kenya to start the first phase of drilling. That's 9,000 meters of drilling, the first 150 meters from surface. And then we'll go on to phase 2 and phase 3, infill drilling down to 40 by 40 meter spacing, and to ideally get to that target of 786,000 ounces of very high grade reserves. Is that it for West Kenya? Well, absolutely not, because the geologists, you know, both on the Acacia side and on Shanta side, believe that there is potential for about 3 million ounces of resources from 2 key areas at West Kenya. The first one is extensions. So we have our 2 resources. You can see here, I think there's a number of six different circles, 6 different targets that we would look to test. And that one there in purple on the Asulu side, we think there's about 200,000 ounces of indicated within the yellow shape in that purple zone. And that, again, that'll be proven through infill drilling. So there's the extensions, and then there's obviously the downstrike. So this is within the Loranda corridor, which plus or minus is about 10 kilometers long. And has already shown all sorts of interesting results from historical drilling that Acacia did. And so we're excited by that. And we've allocated part of the funding that we raised last month to do just that, is to test and to target 3 million ounces of resource. So imagine that in ideally in 2 years, 3 million ounces of resource, 800,000 ounces of reserves. That's a game changer for Shanta. And that work is starting now, and it's fully funded. So to summarize the investment case, again, 3 assets in 2 countries. Will be paying a dividend in April. We're currently generating $100 million of EBITDA against a market cap of 200. And when you add it all up, the net present value of our 3 assets is arguably around about $600 million. So it's about a 0.3 times price to NPV in terms of what you're paying for in the market cap versus what the potential is in value. Now, this isn't something new to us. We've been operating in this area for the last 2 decades. We have 700 employees. That number will go up as we expand these 2 projects. We have a track record of being very careful on costs, repaying debt. The balance sheet now is in the strongest position it's ever been for Shanta. We have $10 million of debt to repay the first half of next year, and we have about, I think it's about $44 million or $45 million of cash right now in our accounts. So that's a very strong position, particularly when we're generating cash and allowing us to fund the growth that we so desperately want to show to the market exists. With that, I'll take any questions.
Okay, so again, these might jump around a little bit in terms of subject area. Straight up, first one, why raise capital only to pay it back via dividends?
Yep, we got that question a few times. Remember, the capital is allocated specifically to West Kenya. It's to do what I've just said it is, to move that project from inferred resource to reserves. That can't happen unless we have allocated capital for that project. Otherwise, we'll be waiting probably the better part of about 9 to 12 months before we can actually get going with that project. In terms of the distributions, we've said that the money from New Louisiana will be used for funding Singida and for funding dividends. Any surplus through additional gold price, we will have the flexibility to give back to shareholders in increasing amounts. Hopefully that answers that question.
Okay, but a couple of questions about political risk. Could you talk to the political risk in the area that you operate, please?
Yes, political risk is important. It's a point where we manage carefully. Now, what I can tell you is as follows: we've been operating in Tanzania for 20 years. We have a very strong social license to operate. What does that actually mean? Well, it means the communities want us to be there, and it means the host government embraces our presence. The government of Tanzania wants Shanta Gold to be mining and expanding. That's a good thing because it means that they're happy. Now, from our perspective, we have a tripartite, which is community, government, and shareholders, and all 3 of those stakeholder groups need to be satisfied with what we're doing. And that enters into the notion of a dividend for the shareholders, taxes to the government, employment and community benefits for the surrounding stakeholders of our mines.
Okay, Tanzanian government recently introduced a law that requires them to take a 16% stake in projects. Does that apply to your Tanzanian projects?
Yeah, so that was introduced in 2017. Those laws. It's been gazetted. It's in the law. We've yet to have a conversation about that. But all I can say is it also comes with a law that says up to 50% of 50% of all taxes and all economic contributions will be made to between the government and the country. The government and the company. And with that, we have a large VAT receivable that we certainly raise as part of that discussion.
So you might use that against the other.
Possibly, yeah.
Possibly. You explained that you felt that the market cap, the valuation the company was given, put no value on the development or the growth projects. And what would be the key milestones that you can achieve to demonstrate and to start getting some value for West Kenya or for Singida to start to change that dynamic?
Yeah, so at West Kenya, let's start with that one, because over the next 24 months, there's going to be about 150,000 meters of drilling. There will be a lot of catalysts that come out of that program. And as we drill, we'll be consistently or continually updating our reserves, so our resources, and ideally declaring reserves. And as we do that, as we show the track record of hopefully being able to meet those targets of added resources and reserves, we believe the value proposition should start to be recognized in the share price. Now with Singida, it's slightly different. I mean, effectively the market's pricing in that we will already be moving from construction to production in 2 years. What I think the market doesn't fully appreciate or doesn't fully give us credit for is the reserve expansion at Singida, and whether we can actually increase the business case, so increase the life at Singida. And we'll be doing that, as I said, hopefully before the end of the year, starting to drill there on the mining licenses.
And next question is about infrastructure in West Africa. Could you speak to that, and specifically electrical supply?
Do you mean West Kenya or West Africa?
Sorry, West Kenya. Very sorry, West Kenya.
Yeah. Okay, great. Well, so infrastructure is good. There we have power. So there's a grid line, which is, I think we'd have to upgrade it about 25 kilometers, which is not a big problem. We have water, which is 4 kilometers away. And then generally getting to site at West Kenya is actually pretty simple. It's a 35-minute flight from Nairobi to Kisumu, and then it's about a 70-minute drive on paved roads up to the site. So it's straightforward to get to. In terms of the actual power, I mean, I see this project being as green as possible in terms of minimizing fossil fuels, and we're doing just that at the new Luigi gold mine. In fact, you can see a picture of that here on this slide. There's some solar panels. We're now connected to the grid, and we hope to get that grid power at New Luigi up to I think about 35 or 40% over the next year or so. And we'll try and do something similar with West Kenya. It's cheaper and it's better for the environment.
Okay, last question is about institutions, and which institutions you have on the register, and did any new ones come in on the recent raising?
Yeah, I mean, for the most part, it was new money that came into this placing, right across from quite a bit of demand, obviously, in the UK. We had new investors out of North America. These were all US based, and some out of Asia, but it was largely UK and US. Now, it was really interesting for me to go through that process. I've been involved in funding different projects throughout my career on the banking side. We had 50 investor calls over the course of 4 days, which was pretty grueling, and we had 40 orders from investors. So, I mean, that was hugely compelling in terms of the hit rate. I think the book was about 2 times oversubscribed. A lot of long-term money that is understands the value and the growth potential, and it's looking at this from a 3 to 5 year perspective. So a very good set of institutions. We're just in the process of getting the updated shareholder list, and we'll put that on the website hopefully in the next 7 days. I think it should be up there once we get it.